now, but initial jobless claims, as I'd mentioned, coming in worse than expected at 584,000 claims, and that's even more than what my next guest had expected, Torsten Slok. He is senior economist for Deutsche Bank and also a former economist at the IMF. And Torsten, it's been a long time since you've been back on my program, so good to see you again.
Lovely to be here.
Okay, so what do these numbers tell you about the job market?
Well, it tells you that we're not out of the woods yet, and it's still early to take the champagne out because the job market is still deteriorating, and that continues to be a worry here for a variety of reasons.
Right, but at previous, I would say even 3 weeks ago, people thought that the job market was stabilizing. So what's going on exactly?
Well, the thing is that the economy is still weighed down by two forces, mainly by housing and by banking, and those forces, unfortunately, take some time before it works through. But the good news is that we're still seeing some early signs of some organic growth in the economy. The economy is on a lot of life support, in particular from fiscal policy, and those signs are definitely more encouraging than they have been for a long time.
Organic growth, but we've seen revenue very soft at several major companies. So where are you seeing that exactly?
Well, the fact is that a lot of the support in the GDP numbers in the coming quarters will come from fiscal policy and government spending and tax cuts.
Okay.
But going forward, the most important thing is that the economy is really driven by three variables or three forces, namely housing and durable consumer goods and business fixed investment. And those three really account for all the variation in the economy, and in particular in housing starts, we have seen some improvements. So the housing market is looking better, and that's definitely something that's good news.
Right, and we did see actually durable goods coming in, at least core, better than expected this week, and so that perhaps is a good sign then. Now, Torsten, as I recall, when I interviewed with you a few months ago, you had actually expected job losses to be up to even 1 million per month, and we never quite got there. We almost got there. So I guess what happened?
Well, we were really worried about the economy 3-4 months ago, and the good news is that the picture has definitely changed dramatically, and we're not that worried anymore. And in fact, we will avoid the Great Depression, and that's why the outlook has changed quite significantly in the last few months.
How about for the jobless rate? What's your expectation there?
Well, the unemployment rate at 9.5 is still quite high. We expect it to go to 9.6 next week, but it's still something that is a really important factor thinking about the outlook, that the labor market needs to stabilize before we think that things are looking much better.
Okay, and for GDP tomorrow, you're expecting contraction of about 2%. That's slightly worse than what the Bloomberg consensus is, or the survey of economists. So are you just more bearish on the recovery or not?
Well, we still think that there's some things that we're worried about, but looking forward, we do think that these organic growth factors become more important. So the economy is set up for a rebound that has the potential to be quite significant. The question is how long time it will take for that to play out, but at least when we get to 2010, we do see some quite significant forces pushing things in the right direction.
Right, but some say that it's the destocking of the inventories really that's going to drive growth. So the question, of course, for all of us is what happens after 2010? What happens when we lose steam on that?
Yeah, no, that's true. After 2010, and we are worried because that's also when fiscal policy starts to come off. So our main worry from a market point of view is what will happen in the next 6 to 9 months. But it's true that in the longer run, there's a number of fundamental questions for the U.S. economy that we're thinking hard about.
And you've mentioned in your note recently that it's the shape of the recovery going up, that's going to be very key. Why is that?
Well, the fact is that when you have a very deep dive in the economy, like we've had during this recession, it's unusually deep, then it's relatively easy to get positive growth rates because you're from such a low level of production that getting just small positive growth rates is much easier, so to speak. And that's why we exactly say that the economy is set up to get positive growth rates, because the memory of the growth is so that growth is from quarter to quarter. So everything that happened in 2008 is sort of gone now, and therefore the quarter-to-quarter growth profile has the potential to be a lot better than what the consensus
But does it matter
expected.
if we get a V-shaped recovery or a W-shaped recovery or an L-shape? I mean, does that really matter in the long run? I mean, is that...
Well, one thing which is very important about the shape of the recovery is the interplay between what's happening with economic fundamentals and what's happening in financial markets, because financial markets have a huge, important impact on the economic recovery. So risk appetite coming back has been a really important, helpful indicator, a helpful force for the economy to get back on track. And a lot, therefore, depends also on whether risk appetite is about to take further off or whether it will go down again and take another leg down.
Okay, and finally, Torsten, then, in terms of the exit strategy for the Fed. Could that derail any growth? I mean, could they do it too early, for instance?
Yeah, they're really caught in a difficult situation here, that if they do it too early, meaning taking policy easing off too early like they did in 1937, then that's both fiscal policy and monetary policy. The risk is that the economy will start to dive down again. But at the same time, if they start tightening too late, they of course risk that inflation will begin to take off. And that's really the risk that they are balancing here. And that's not an easy task. That's a huge challenge and a huge headache for the Fed here.
That's the underlying thing to watch out for. Torsten, great to see you as always. Thanks so much for joining us. Torsten Slok, senior economist at Deutsche Bank.